Hello, everybody. My name is Chris Myrie, and in this presentation, I will give an overview of BancFirst risk and performance from Q2 2023 to Q1 2024. Now, just a brief overview of who we are. We are a financial institution based in Oklahoma with a primary focus on community banking. Our services include personal banking, business banking, wealth management, and mortgage services as well. And in Q1 2024, we generated just shy of $45 million in earnings. And to the right, you can see a screenshot of our balance sheet over the past several quarters. So, looking at its initial performance and risk, and specifically with its performance stability, we displayed minimal volatility in key performance ratios, with ROE decreasing slightly from 4.2 to 3.9%, and ROA from 0.45 to 0.42% between the time horizon. And profitability metrics, including net interest margin, showed similarly small changes as well. Looking at our credit and risk, there was some volatility with net charge-offs spiking from 0.06% to 0.22% in Q1 2024, while other metrics such as total loans and total deposits remained stable at just about 70% across the board. Our capital risk remained low as well, with stable equity capital levels. And looking at our initial profitability, despite increasing total revenue, BancFirst profitability declined slightly due to rising interest expenses, which increased from $37.7 million in Q2 2023 to $54.7 million in Q1 2024. And that was probably as a result of the rising interest rate environment that we have been in over the past couple of years. Now, compared to its peers, BancFirst actually displayed higher profitability across the board. Looking at the ROE net operating margin, you can see that we were more stable and more profitable across the 4 quarters. We also displayed higher liquidity risk compared to its peers. However, it is less risky in terms of its credit and interest rate risk. BancFirst was shown to be significantly less volatile than its peers as well. And the peer group, however, outperformed BancFirst in terms of its operating efficiency. However, that was they outperformed only by a slight amount. Now, looking at BancFirst interest rate risk over the past 4 quarters, in terms of its sensitivity, we remained liability sensitive in the short term, specifically in the 0 to 3 month and the 3 to 12 month maturity buckets, consistently showing negative gaps in these periods across the board. And in the long term, BancFirst has shown to be asset sensitive in the 1 to 3 year and the greater than 3 year maturity buckets. There were positive individual and cumulative gaps in these periods, highlighting its significant long-term asset sensitivity. And looking at the effects of interest rate changes on BancFirst, it's widely expected that the Federal Reserve will reduce short-term rates, with long-term rates expected to rise, and this will likely increase BancFirst's net interest income. Furthermore, with BancFirst being asset sensitive in their longer maturity buckets, this increase in long-term rates will likely cause those long-term assets to reprice, generating more income for BancFirst as well. And now, compared to its peers, BancFirst and its peer group saw similar interest rate trends from Q2 2023 to Q1 2024. In the less than 3 month category, both BancFirst and its peers became less liability sensitive across each quarter. In the 3 to 12 month maturity bucket, our peer group became more liability sensitive across each quarter. In the 1 to 3 year, BancFirst and our peer group became more asset sensitive over each quarter. And in the greater than 3 year bucket, both us and our peer group became less asset sensitive across each quarter as well. Now, looking at BancFirst's overall liquidity risk, we did maintain stability in key liquidity indicators. For example, our cash position ratio was maintained at just above 20%, and our liquid securities ratio was just above 10% as well across the board. Highlighting some areas of concern, however, BancFirst's net federal funds and repurchase agreements positions consistently showed illiquidity with a ratio below 0%. And our pledged security ratio increased from just about 5% to 8% in Q1 2024, which could also indicate decreasing liquidity. So those are some areas that we should keep an eye on going forward. And looking at our hot money and deposit trends, BancFirst hot money ratio declined significantly from 19.7 to 10.7x, indicating a reduction of funds allocated for short-term returns. And that in turn can impact liquidity, but it supports profitability. And the deposit composition ratio also declined, reflecting more stable deposits, but weaker liquidity. And looking at our core deposit strengths, the core deposit ratio remained high at just about 87% across all quarters, reflecting a strong and reliable funding base from our regular customers. And overall, BancFirst liquidity slightly weakened from Q2 2023 to Q1 2024. However, we do have to keep in mind that there is a trade-off between our liquidity position and our profitability position. So typically, the more illiquid we are, we have a higher chance of profitability, but we have to make sure we keep that balance in check. Now, comparing this to our peer groups, we did show a stronger cash and core deposit ratios compared to its peers. However, there was mixed performance in other ratios. BancFirst showed better results in the net federal funds and repurchase agreements position, as well as a pledged securities ratio. However, we underperformed in the liquidity securities indicator, whereas peer group held more government securities, as you can see to the chart on the right. And looking at trends of future risks, BancFirst hot money and deposit composition ratio declined across each quarter, while its peer group saw increases or stability. Now, looking at our capital adequacy and credit risk, specifically with our capital position, BancFirst consistently maintained capital adequacy ratios well above the minimum thresholds for being classified as well capitalized across each quarter, with metrics such as total RBC, Tier 1 RBC, and the like, showing stability and reliable capital management. With our loan restructuring and credit risk, BancFirst consistently maintained the majority of its restructured loans in compliance with their modified terms, despite a slight increase in non-compliance across quarters. So overall trend, BancFirst capital position, its strong restructuring performance, steady loan portfolio distribution, and superior metrics compared to its peer group highlight effective credit risk management practices. And now, compared to its peers, both our company as well as our peer group were both classified as well capitalized throughout each quarter. However, BancFirst capital adequacy ratios were consistently higher than its peer group, indicating a slightly stronger capital position. However, our largest loan categories closely mirrored its peer group with minor differences in fourth and fifth place rankings. However, their smallest loan categories differ significantly, with the peer group's smallest category being insider loans, unlike BancFirst. Furthermore, we outperformed our peer group in restructuring loans with a significantly higher compliance ratio. For example, Q1 2024, our loans in compliance were approximately 77 times greater than our loans not in compliance, compared to our peer group 16.5 times its non-compliance. So overall, when compared to its peers, BancFirst is shown to have a lower credit risk. And thank you for thank you for listening to this presentation. And I was happy to highlight some major areas regarding BancFirst risk and performance over the past several quarters. Thank you.